World share market performances were mixed in May. Japan was the best of the major global markets, rising by 5.1% in local currency terms, while the US market delivered a relatively modest gain of 1.3%. Elsewhere, Germany, Hong Kong and Singapore delivered negative returns. Emerging markets also lost ground, with Brazil, Russia and South Africa recording the largest falls. The Australian dollar performed poorly against most of the major currencies except the Japanese yen during May. It was down by 3.3% against the US dollar, 2.9% versus sterling and 1.2% against the euro. And this weakness was due in part to the Reserve Bank's decision in May to reduce the cash rate by 0.25% to 2%. Overall, global shares managed on an unhedged basis outperformed the return on a hedged basis. The return of the Australian share market was relatively modest, up just 0.4%. Unlike previous months, resource companies performed well as oil and iron ore prices recovered from recent lows. Aside from materials, healthcare, industrials and property trusts were some of the best sector performers. However, the major banks lost ground, as well as consumer staples such as Wesfarmers and Woolworths. We've commented before that very accommodative monetary policies and historically low interest rates have helped underpin share prices, and the month of May was no exception. The European Central Bank launched its own quantitative easing program in March this year, while Japan's has been in place for some time. Japan's anemic economic performance and the slow recovery in Europe highlight the need for monetary stimulus. In contrast, America is expected to commence raising interest rates later this year. In Australia, the Reserve Bank reduced the cash rate by another 0.25% after a similar reduction in February. And the bank considered this action was appropriate because Australia's economic growth is likely to remain below trend for longer than previously had been expected. While low interest rates and quantitative easing have helped markets achieve strong returns in recent years, it also means return potential from here looks very limited. This is because valuations in both share and bond markets are at high levels. Bargains are hard to find. The Reserve Bank's decision to cut interest rates again is a sure sign that the Australian economy needs a helping hand. The economy is growing, but it is below trend growth and has been for some time. Of concern is the continued decline in mining sector investment, while non-mining business investment remains subdued and is likely to remain so into 2016. Economic statistics released during the month confirmed the immediate outlook for growth is subdued. Wages growth of 2.3% in the year to 31st of March was the slowest since 1998, and the unemployment rate increased 0.1% to 6.2% in April. However, it's not all negative. Dwelling investment, exports and consumer spending are growing, as is consumer sentiment.